Hello, I'm Rob Goldman from Goldman Small Cap Research. Welcome to How to Build Wealth, an introduction. Before we get started, a few disclaimers and this presentation is for information purposes only and should not be construed as an offer to sell or buy securities or provide financial and/or investment advice. Goldman Small Cap Research, the Investor Academy, and Parent Two Triangle Consulting Group are not registered with FINRA or any agency as an advisor or broker-dealer. For more information or additional disclaimers, please go to www.goldmanresearch.com for additional disclosures. Let's get on with the show, shall we? As I said, this is an introduction to how to build wealth, so some of the things we'll be discussing are really very basic. However, in some circles, it may not be. For example, what is wealth? To some people, wealth is owning a huge house, or perhaps buying a new car. Is that the case? Absolutely not. Is wealth sitting on a boatload of cash? Not really. There are a couple of old adages here you might be familiar with. One who loves money will not be satisfied with money. Who is rich? He who is satisfied with his lot. These old adages really make sense even today. One thing's for sure, however. Everyone can achieve wealth. So how do you achieve wealth or build wealth? Here are four sayings that we refer to as our philosophy of four that are applicable to all times and all places. Save your money and your money will save you. If you have an emergency and have no savings, you're out of luck, right? That's pretty basic. Early to bed and early to rise till you get enough money to do otherwise. You got to work hard for your money. That means working perhaps 2 jobs, working hard, working for your community as well. It's not just the work that you do to generate the income, and we'll be talking about that a little bit later. But if you want to be able to retire and have generational wealth for your family, your children, your children's children, this is going to be a real key tenet. Pay yourself first. I don't care what the obligations are that you might have financially. When money comes in the door, whether it be salary, commission, you sold a piece of property, pay yourself first. Even if it's just a small percentage, it goes back to the saving the money. Get you in a good habit. Make your money work for you. Just sitting on cash is not going to do any good because you're going to be killed with inflation over time. The money does truly have to be invested in other vehicles, be it real estate, income producing vehicles or equity vehicles. Let's explore. The 5 stages of wealth building are pretty simple. The most important is to understand what you're getting into. And wealth building is a marathon. It is not a sprint. Get-rich-quick schemes are really lose-your-money-quick schemes. We certainly wouldn't recommend that. It takes time to build wealth. How do you do that? First of all, you build the infrastructure or that bottom pillar of a pyramid by going to the mattresses, sticking 3 to 6 months of your expenses in cash somewhere, savings account, a money market account, a brokerage account. You want to have some in your house, that's fine too. But you're going to need that money for emergencies at some point in time. You also, of course, need to invest in insurance, life insurance especially, so that when you pass, your spouse, your children, your children's children do have some funds later on. Most families and most people that are wealthy are not necessarily independently wealthy. Many of them are wealthy due to the fact that they received funds relating to cashing in life insurance, which was part of wills, estates, and things of that sort, which we're not going to discuss actually in this presentation, but is important to recognize and be aware of. Types of investments you can make include investing in equities, such as mutual funds or stocks. Now be aware that there's risk here. You do have to take some risk to make money, however. If you are risk averse, or perhaps you're retiring soon, you don't want to invest in something where you could lose your principal. You can invest in bonds, or more in a savings account or money market accounts, where in a sense you're controlling how you get paid from the standpoint of you understand and know what type of interest rate you will be paid and for what type of term. If you have needs, you're retiring, there's a health obligation, saving for college, make sure that where you're putting your money is not somewhere where you're going to have it at risk or all of it at risk. You must diversify and have funds that would be what we would consider capital preservation, which will also generate you an income, but ensure that you have the money for that obligation in the future. In today's society and culture, most people have engaged in the absolute wrong philosophy with respect to building wealth. They've been more about show rather than substance. Make wrong decisions on a daily basis with respect to their plan. So let's take a look at what the right philosophy is side by side against the wrong philosophy so we can engage in the right one and reach the promised land of wealth building. Investing in your education makes you money. You'll make more money from the salary perspective, more opportunities will be there for you. It's more likely that your children would engage in higher education as well. Really, that's the beginning and the end, right? Unfortunately, too many people are spending less money on education and more money on entertainment, being able to travel, go out, sporting events, whatever it might be. Just because you can do those things doesn't mean that you're wealthy. And if you don't have the education to fall back on, it's going to be a real big problem. You should be accumulating assets instead of accumulating possessions. An asset is something that grows in value over time. A possession is something that you just want to have but decreases in value over time. And our houses are filled with possessions, but our balance sheets are not necessarily filled with assets. And that's what we've got to take care of. We should diversify our investments as opposed to putting all of our eggs in one basket, no matter how exciting or how great that investment might look. This way, in case one thing breaks down, you've got others to fall back on. Too many of us, and I'm speaking of on a personal basis, on a company basis, use debt incorrectly. We should use it as leverage for your house, right? As opposed to using debt to buy things, going back to this possessions thesis, or for travel and things of that sort. Using cash for those things if you wish to buy things to that end. But use debt only as leverage. That'll help you with the cash flow down the road. Money is just a means to generate the wealth. It's not the generation of the wealth itself, because there are so many other factors that we discussed before. One interesting misnomer is that being paid a high salary is actually pretty meaningless in the grand scheme of things, because if you're not saving, if you're not engaging in the right philosophy, then that salary really goes to waste now, doesn't it? Building the wealth is also about taking care of others, taking care of your family, taking care of your community. There's some that have the philosophy of, I'm just going to spend it because I can't take it with me. Well, you may have kids, you may not have kids, but you really can't take it with you, it's true. However, if you can't benefit from it, shouldn't someone else? And that's really about taking care of the community at large, as well, of course, as your family. You drive cars, and investment vehicles should drive your wealth. As I mentioned before, you want to diversify and invest in a variety of things. Going back to that idea of the pyramid, you want to have cash, you want to have income producing vehicles such as bonds or bond mutual funds perhaps. You want to invest in equities, shares of companies, both directly into stocks, like blue chip stocks, very large companies, or equity mutual funds, which own a basket of stocks, whether they be large, medium size, or small. Growth stocks, very small companies. These, of course, tend to be riskier, so be aware that there could be very big fluctuations there. Real estate is typically a great investment, increases in value over time. You can also invest in startup companies through crowdfunding and microloans and things of that sort. The key takeaway here is that by diversifying your investments, you're going to generate and build your wealth over time, and do it in a way that lowers the risk and increases your reward. Obviously, the $64,000 questions are how, when, what, and how much, and what can you make on these investments. It obviously depends on a whole variety of factors. It depends on what you're investing in, how much. You've got to research these things. That's why knowledge is power. Make sure before you do anything, you read everything cover to cover. Consult people that are informed, investment pros, your accountant, even people that have done this before that may not be professionals. Always good to consult with them, although not necessarily use their advice, but interesting to hear perhaps some of their war stories. Be prepared and have a plan. If you want to build wealth, and you know you need or you require or you want to have a certain dollar amount at a certain time, you've got to have a plan. Speaking with a financial planner or advisor will certainly help you do that. In order to be prepared and have a plan, you've got to have those first two stages down pat. A lot of people tend to just go right in, half-cocked, and without a plan, they don't reach their goals. It's a real issue. Understand the difference, but yet the relationship between risk and reward. The greater the risk, the greater the reward. But the greater the risk means the greater the potential loss as well. You're going to have to weigh this with respect to where you're putting your money and your goals. You'll be discussing that with your investment pros and your accountant as well. Some people hear things and invest things, buy things, loan money to various opportunities, if you will, that sound great. The problem is they do it perhaps because they want to keep up with the Joneses, their friends have done it, or it just sounds cool, they read about it in the paper or online, but they don't really know what they've gotten themselves into. And it's not that they've done something that has put themselves in peril, but perhaps they got in over their heads from the standpoint of not really knowing exactly what it is. Make sure you buy what you know, because you're going to be most successful in doing that, and therefore you will know what you buy. It's your money. Don't buy something that someone else has all the knowledge about. You need to have that as well. There are real common investment mistakes that happen day in, day out, beginners and pros alike. You can avoid them by engaging in the following things. Have a plan and stick to it, as we mentioned earlier. Don't follow the crowd. The crowd is usually wrong. Some people like to talk about that with respect to gambling. If everyone is betting on one side, you should bet on the other. It's one of the reasons why casinos tend to stay in business, right? Keep your emotions in check. This is particularly important with respect to equity investments, since there are always large fluctuations, or certainly the capacity for large fluctuations. By keeping your emotions in check, you won't make mistakes, selling too soon, buying too late. A lot of times there's information overflow online from so many different sources. Don't get overwhelmed. Stick to the basics. Don't chase investments. Don't chase the latest and greatest. Because if you are, it's probably too late, and your risk is greater than your reward. As I preached earlier, don't put all your eggs in one basket. By diversifying across stocks and real estate, of course having insurance, maybe some bonds, things of that sort, if one of these silos happens to fail and you lose money, at least it'll be offset by gains somewhere else. There's some real resources out there aside from Goldman Small Cap Research that you can visit on a daily basis. There are online magazines, print magazines such as Business Week, Money, and Kiplinger's. And if you're really new to all of this personal finance and investing stuff, these are really great sources because they will speak at your level, not really on a high level for investment pros. On the web, tons of places to go as well if you're looking for specifically investments in the stock market and to some degree with bonds. SEC.gov, NASDAQ, some online brokers like TD Ameritrade and E-Trade, MSN Money, MarketWatch, which is really very heavy for the stock market, along with Yahoo Finance, which actually is probably the most visited for stock market investors, certainly do-it-yourselfers. On TV, there's the Fox Business Channel and CNBC, and we'll be introducing as a separate entity very soon the InvestorAcademy.com. Right now, it's just a part of Goldman Small Cap Research. So, in summary, everyone can be wealthy with the right mindset. As long as you understand that wealth building is a marathon and not a sprint, and you diversify your investments, you're going to be in great shape. How do you do that? By being different. Don't follow the herd. Don't follow the crowd. Stick to your plan. Seek out help when you need it. If you don't know, or you need to know other information, don't be afraid to ask. Seek out the professionals. Obviously, you want to build wealth so you can be comfortable today. But if you really want to be successful at this, you're going to be looking out much further and building generational wealth for your family. And while you do that, give back to the community. You never know how these things turn around. Perhaps other investment opportunities also come back at you, which enables you to build wealth to an even larger degree. It's a great way to live. Live through building assets, taking care of yourself, your family, and your community, as opposed to acquiring possessions. That's a real important takeaway. So thank you very much for your time in viewing our presentation today, How to Build Wealth, an Introduction. We'll have a follow-up to this presentation in the next couple of weeks on our website, www.goldmanresearch.com, and be on the lookout for the launch of our new website, the InvestorAcademy.com, which is going to be the home for all of these webinars on the personal finance side as well as the investing side. We're going to have blogs and articles on the personal finance front as well. In the meantime, whether you're a new investor, an intermediate investor, a pro, you must sign up for our new webinars on the investing front. Each of them is a series of 3. Teach you how to invest, teach you how to trade, teach you how to build wealth in ways that you probably have never seen or heard before. Very low priced. Go to our website, goldmanresearch.com. You'll find links to those series there. And again, we'll be launching the InvestorAcademy.com in the next few weeks. Thank you very much for your time, and best of luck.